She's getting ready to leave her post and go back to Harvard. And I want to talk to you in a minute, Carmen, about your year and your reflections on it. But let's start with inflation, because you have been dealing with this more and more over the past 2 years at the World Bank. Do you agree? Are central banks doing the right thing and enough to start bringing down inflation globally?
Well, I think that certainly it got started later than I had hoped, the efforts to bring down inflation. And I do think, and I have been on camp persistent for some time. So it remains to be seen, Kathleen, just how successful and how swiftly this can unfold, because we do have a lot of headwinds. The war continues, the commodity price surge continues, and supply bottlenecks are still alive and well. So it remains to be seen how successful these efforts will be in the near term.
So as we zero in on what you've been zeroed in on at the World Bank, of course, it's the emerging market economies, it's the developing economy, it's some of the most poorest economies. So what about social unrest? We look at Sri Lanka, we look at Pakistan, we look at Laos. Who's next? How severe are we going to see the push back against higher prices, food crises? What do you see there?
Well, look, first and foremost, inflation is a tax, and it's a very regressive tax that hits the poorest countries and the poorest households. So it's not surprising Sri Lanka is running close to 40%. We do have Turkey running about 70%. And of course, countries like Egypt are struggling with high food prices. Many countries in Central Asia, Eastern Europe are also facing serious inflationary pressures. The question you pose of how much civil unrest, well, one has to remember that the Arab Spring had many, many reasons and many complex sources, but certainly the food price surge of 2008, 2009, and the unrest associated with that is fresh in our minds.
What about emerging market debt? There was a warning in one of our stories on the Bloomberg terminal today, someone looking at this and saying that that is something else that is potentially, at the very least, something the investors should stay away from. But if emerging market countries are facing debt problems or just even trouble servicing their debt, that's something that I would assume is going to continue to be a big concern for their own policymakers and policymakers in developed countries.
So, the debt problems are, if we look back at the drama of August 1982, when Mexico defaulted, we are not at that drama moment. We're not at that Lehman moment. But the list of countries that are facing debt distress or high risk of debt distress is quickly mounting. The rise in U.S. rates, China, who had been a major lender, has scaled back lending recently. And of course, we have the uncertainty that the risk-on environment that we've had during the low-rate environment may turn to a more permanent or long-lasting risk-off, which blankets the emerging markets. All of those things add to the debt risks. I would conclude by saying that with the low-income countries, debt risks and debt crises are not a hypothetical. We're pretty much already there. It's just that those countries are small and don't grab the headlines the way the big emerging markets do.
And Carmen, next month we're coming up to 25 years since the start of the Asian financial crisis. In the context of everything that you've said so far, do you feel like the region overall is better placed to cope with the next financial crisis?
It's not going to be an Asian-style financial crisis. The Asia financial crisis came after, big bonanza, fast growth, surging capital flows, big current account deficits. We're not there. The kinds of problems that we're facing on the debt front have to do with stagflation, have to do with lack of recovery. This recovery has been exceptionally uneven, very different from the recovery of the global financial crisis, in which the emerging markets recovered far more quickly than the advanced economies, importantly because China was providing an engine of growth back in the aftermath of the global financial crisis that is not providing now.
There's a concern that given perhaps the lateness of central bank reaction to inflationary pressures, that the inflationary psychology is already set in, and that's spiraling into this negative cycle of growth expectations as well. Is the fear of entrenched stagflation something that's real to you right now?
Yes, it is. It's very real. It's very real because also, look, we're in the early stages. And what makes also inflation persistent is when it spills over beyond the goods market, beyond the commodity prices that we've already seen. It's when wage pressures start to mount. Now, the weak recoveries are mitigating for the time being some of those wage pressures. But remember, in emerging markets, inflation expectations are not nearly as anchored as they are in advanced economies. So the inflation concerns are going to be, I think, a big factor for EMs in general. And for some already, it's well, we have practically 90% of emerging markets already with inflation rates above 5% and many more over 10%.
Carmen, you started your 2 years, your 2-year stint, leaving Harvard for a couple of years to put, academic research and theory into practice. So July 2020, middle of the pandemic, we think we're getting ready, through the pandemic and seeing the other side. War in Ukraine starts so much. What has that been like? And if you could say lesson learned, what is it, or are they?
Well, I think a lesson learned was the very quick response by the multilaterals to deal with the initial onslaught. There's no other word for it, of the pandemic. I think the debt service suspension initiative was, a welcome step also in that direction. But I'm more concerned with the lessons not learned. And among those lessons not learned are that debt crises need to be resolved through meaningful debt reduction, meaningful debt restructuring. If not, it's a Band-Aid, and it's a Band-Aid that wears off very quickly. And I think the lesson from past debt crises is that without deep debt restructuring, what investors call haircuts, the debt problems are going to be with us for some time. And I think that the lack of any debt restructuring, not a single one, with more than a year and a half now into the common framework that the G20 put forth, is indicative that we are moving very slowly.
Yeah. Well, Carmen, one quick final question. So now, what are you working on next? What's the big issue or issues that we're going to be talking to you about the next time you join us here on this show?
Look, Kathleen, as you know, I've worked mostly on crises issues, and there is no lack of this. In the World Development Report this year, we devoted it importantly to some of the financial frailties caused by the disruption of COVID. And now we have, to boot, the Russia-Ukraine war, which, as we know, has led to inflation. So look for talking to me more about inflation, about financial fragilities, which continue to be a source, and the debt issues that we've been talking about. I think none of those are likely to go away very soon. And, I think right now the big hope is the hope of a soft landing, that central banks in the major economies will be able to engineer one. I am skeptical.